All right, in this lesson, we are going to talk about categories of accounts. Now, to kind of give you a background of what we're trying to do here is accounting is all about taking data, right? So it's taking data, putting it through an analysis to get a summary of reports. Well, as part of the analysis is we're going to take all of the data and we're going to have to organize it some way when we record them into the books of an organization. And so these are categories that we're going to talk about. These categories are like buckets. So we're going to have 6 buckets here. And every transaction that goes to the accounting system, all the data that goes into the accounting system has to be put in one of these 6 buckets. Now, from these buckets, we're going to go even more granular and we're going to have accounts. We'll talk about accounts in the next video. But this video is all about the major buckets, so the major categories where we take the data and we put them into the bucket. So I'm going to help you understand these categories here. In the next lesson, I'm going to help you understand what accounts are. And as we go through this course, you're going to need to understand these categories and accounts in much detail. This is super important to actually passing a principles of accounting course. If you don't understand these and the accounts and some of the other things in the first 3 or 4 sections, you will be lost for the entire course. So I can't state it enough. This is super important, even though it kind of is just definitions and understanding that. So with that being said, let's talk about the categories of accounts. So what do we do with this information? So we have all of this data. What do we do with it? Well, we have to categorize that into different categories. And so we've got really 6 categories here that we can look at. So the first one is an asset. A second one here is liabilities. We also have stockholders equity. Now, really quick, those 3 are our big 3, okay? But we can break down stockholders' equity even more, and we're going to get something called revenues, expenses, and dividends. So there are 6 categories, but logically we have stockholders' equity, which also can mean revenues, dividends, and expenses. So those are our 6 that we're really concerned with going into the next couple of sections. Now, what we're going to do here is I'm going to explain each one of these categories to you so that you have an understanding of what each one of these means. So we're going to start off with assets. So assets are a company's resources which the company currently controls. Notice it doesn't say own, although usually it means own, but what the company controls that is expected to yield a future benefit. What do we mean by future benefit? Typically in future cash flows, but could be a support of another asset, which does provide future cash flows. So what is an example of an asset? Well, it's a company. Assets are a company's resources, which the company controls that is expected to yield future benefits. So here are some examples. We've got cash. Is cash an asset? Well, does it provide future benefits? Sure, we can take the cash, spend it on a machine. The machine makes us more widgets. That widget we can then sell out to the public and create revenue. So it does provide future benefits. So cash is an asset. Equipment is an asset. So what is equipment? Well, equipment, just like I said, is a machinery that makes widgets. That widget we can sell for revenues. That becomes an asset. So assets are things that we control. Typically, we own them. That we can provide future benefits by the use of them. Okay, so cash, equipment are those 2 are assets. Another one we have is buildings. Well, we're going to have to house our employees. We're going to have to house our warehouse. We're going to have to house our manufacturing plant. Those are assets. If we didn't have that, we couldn't do what we're trying to do to produce revenue. So these are examples of assets, things that yield benefits to an organization over a long period of time. That's what these 3 are. So assets, important part of an organization. Now, talking about liabilities, liabilities are pretty simple to understand here. These are debts owed to another party, usually an outside party that is typically satisfied with either providing a service, cash, or another asset. Think about a consumer credit card, a home loan, or a car loan debt, but for businesses. So let's think about it. So liabilities are what a company owes to someone else. And the way that they satisfy it is not always through cash. So sure, if they took out a bank loan, they would have to pay the bank back in cash. Now, what about if you buy a gift card to, let's say, Target? Well, Target owes you the value of that gift card. Well, how do they satisfy it? They don't pay you back in cash. They pay you back by giving you an asset, one of their assets. We call it inventory. So you go into the store, you buy a box of cereal. That cereal is an asset to them because it provides future benefits. By selling it, they make money. So that cereal they give to you, that releases your claim on them for the gift card amount. So if it just happens to be $5, you release them of a $5 claim on that gift card when you give them the gift card and they give you the box of cereal. Services, same thing with services. So we could prepay for something. For instance, you might have to put a deposit on a facility that you're renting, but you're not really taking anything. You're not going to get an asset. You're just renting the facility. At the end of the day, once you've rented, they get to keep that deposit. So that is a example of a liability that is satisfied with a service. The service is providing you the opportunity to use their facility. So that is a liability. Things that the company owes to someone else, and it's usually satisfied either through providing a service, cash, or some other type of asset. Examples of these liabilities. Now, these are technical terms, so I want to make sure that you know that these are terms that are technical to corporate accounting. You're going to need to know these, but these are what they are. So accounts payable. So this is when I owe the company owes another company for, let's say, purchasing inventory so that I could sell on my shelves to customers at the end of the day. We will go through more of these later on, so it's not imperative that you know the definitions of these three, but that we're just providing you an example. So accounts payable, notes payable, same thing, except this is usually a written note signed by two parties. So like a bank loan, there would be a note signature, and that's what's exchanged. And then salaries payable. So if you're an hourly worker, for instance, you might have worked last week but haven't gotten paid yet. You get paid next week after the pay period's over. And so after you work that week, the company still owes you that money. So if you quit at the end of that week, they still owe you for that week's pay. Therefore, they owe you money. So that's called salaries payable. They have to pay some type of salary that is owed to an employee. So those are examples of liabilities. Like I said, we'll go through these more in depth later on, but we just want you to get a high level understanding of what examples of liabilities. We don't call them credit card debt. We might actually call them loans, but we don't usually call them credit card debt. All right, moving on. Stockholders equity. So generally, stockholders equity represents an owner's claim to the business through either capital contributions, we call that capital stock, or through earned capital retained earnings. So here's an example of stockholders equity. So stockholders equity is basically whatever an investor puts into the company. So for instance, you're starting a new company. Your company needs $1,000 to start. So you as the investor, the owner, put $1,000 into your company. That's contributed capital. You are putting $1,000 into the company in exchange for really nothing, just ownership in the company, okay? Now, earned capital means is what the company makes at the end of the day. So at the end of its first year, if they make $500, well, since you're 100% owner of that company, technically you've earned that $500 as well. That's called contributed capital. Now, the company instead may say, hey, we are not going to distribute that to the shareholders, me, the investor. We're going to retain that And why are we going to retain it? Well, they're going to retain it because that allows them to invest back into the business. So contributed capital, earned capital is capital that the company earns, and then they retain, the key word here, retained earnings, because they're deciding to retain it instead of distribute it to its owner so they can reinvest in the company. All right. Now, earned capital or retained earnings is made up of a whole bunch of things. This is kind of an example. Revenues, expenses, dividends, and owner's capital. So owner's capital technically belongs up here, but we're trying to get you to understand the whole idea of owner's capital and all of these put together. Okay? All right, so let's look at the stockholders' equity equation. So stockholders' equity is equal to owner's capital, so what you put in, plus revenue, so whatever the company makes, minus expenses, so whatever expenses they incurred, minus dividends, whatever they've paid back to shareholders. So a dividend is what they paid back to a shareholder. So for instance, if the company made $500, they have two choices. They could keep $400, reinvest in themselves. We call that retained earnings. And then they can distribute $100 as a dividend back to its shareholders. So company makes $500. They said, okay, we're going to hold $400 because we want to reinvest in our organization, but we also have $100 here that's left. We're going to distribute that back to the shareholders in a form of what we call a dividend. So that's the stockholders' equity equation, and that's what a dividend is. Now, examples of owner's capital when we separate stockholders' dividends, revenues, and expenses. Well, stockholders' equity is also known as common stock, additional paid-in capital, and retained earnings. So common stock is the stock that we purchase. So if I put in $1,000, that's common stock. Additional paid-in capital usually is what we put above that. So after 4 years, if the company needs $10,000, I would put $10,000 more into the company. And so my initial common stock is $1,000. My additional paid-in capital is $10,000 for a total investment of $11,000. Retained earnings is what the company retains. So that $400 that I showed you a minute ago, that is earnings that the company earned but didn't distribute to the shareholders. Instead, the company retained to reinvest in its operations. Now, understanding retained earnings versus dividends. So I've already gone through this, but a company has net income, and they can either distribute or not distribute that income. When we call it distribute, we call that a dividend to the shareholders. For retained earnings, we call that retained earnings. So a company can retain the earnings instead of distributing. All right, let's talk about the rest of them here. We've got revenues. So revenues are amounts earned through normal course of business. So whatever the company does on a normal basis, that is called revenue. So for instance, Southwest Airlines, what do they normally do? They transport passengers from point A to point B. So when you buy a ticket on Southwest Airlines, that amount that you paid for is revenue. Now, amounts earned from what the business does on a daily basis. So that's revenue. But Southwest Airlines also sells their plane. So after 13, 14 years, they're going to sell their plane to maybe another company. Typically, it's another company in a foreign country for less amount of money. So they're going to sell their planes, but that's not what they do on a normal basis. We don't call that revenues. Sure, they're making money, but it's not called revenues because they normally don't just sell planes. They normally provide transportation services from point A to point B. So that's revenues. Examples of revenues, these are different accounts that we would call them. Sales revenues, service revenues, sales. So sales revenues usually go along with companies that actually sell a product to a customer. So if you go into a grocery store, if you go into a clothing store, that is sales or revenues. Service revenues is a company that uses this type of account when they are providing a service to you. So a barber shop, a dry cleaner, amusement park. Those are companies that are providing you a service. So they don't call it sales revenue, they call it service revenue, because sales revenue has to do with goods being exchanged for cash or goods exchanged for some type of monetary value. And then service is providing a service which the customer doesn't really take anything at the end of the day in exchange for some type of monetary unit. Okay. So let's move on to expenses. So expenses are amounts used or incurred. Cash does not have to be paid though, and we'll talk about that later, through the normal operations of a business in pursuit. Resources used from what the business does on a daily basis. So what that means is what does the company have to use in order to generate the revenue? So for instance, Southwest Airlines has to consume gas, okay, Jet A fuel. That Jet A fuel costs money to Southwest Airlines. That is an expense. In order to ride on a plane, you got to have a pilot and flight attendants. That is labor cost. That's an expense because they have to incur that expense in order to provide you a service, thereby giving them revenues. If they didn't have a pilot, a co-pilot, and flight attendants, then they couldn't provide you services. Therefore, they wouldn't have expenses, but they would also not have revenue. So expenses are typically amounts used or incurred through the normal operations of a business in pursuit of revenues. Examples of expenses are rent expense, marketing expense, and payroll expense. So rent expense, if a company decides to rent out a facility, they're going to pay rent expense. Marketing expenses, obviously, we have to market our services or our product to the world, and so we might incur marketing expenses. And then payroll expenses, we're going to have employees. I don't really know of any company that doesn't necessarily have employees per se. You could probably find some instances, but most companies are going to have payroll expenses because they're going to have employees to operate the business. So those are an example of expenses. Moving on to dividends. We talked about this, but we'll rehash it here. Dividends are amounts distributed to the shareholders from current net income or accumulated profits. Accumulated profits is retained earnings. So accumulated profits, the idea of accumulated profits is that that $400 that the company retained, well, that could be distributed back to the shareholders at some point. And when it does, we call that accumulated profits because it's the profits that have been accumulated over time that have not been distributed to shareholders. And at this point in time, we might be able to distribute them now to the shareholders because we don't need it anymore to reinvest in our organization. So dividends must come out of current, so net income, or accumulated profits or retained earnings in order to pay those dividends. Now, a dividend must be paid from undistributed net income earned in the past or currently. So what we're saying is, in order to distribute $100 to a shareholder, we actually had to have made $100. So if the company took a $1,000 loss last year and have never taken a profit before that, then their retained earnings is a negative $1,000 technically, which means they can't pay a dividend to a shareholder if they don't have any profits from now or in the past to be able to pay that shareholder. So that's a problem. And so we need to have some type of income. Now, if we have a loss this year, but we've had profitable years over the last 15 years, and we didn't distribute all of those profits those last 15 years, then we can actually pay a dividend this year even though we have a loss because we have accumulated profits from the past that we're able to pay today. So we must have profits in order to pay a dividend. Dividends are not expenses. So number one thing that students often have a problem with is dividends are not expenses. Dividends are dividends. They are distributions to shareholders. Now, why is that important? There will be a statement in which you are going to have to do called the income statement. It only has revenues and expenses. This dividend is often included in there as a trickery to see if you bite, because it seems like dividends are expenses, but they're not, because they don't have to be paid in pursuit for revenues. I don't have to pay a dividend to a shareholder if I don't want to. Usually you do because you want to keep them as an investor, but you don't have to pay them. Companies like Google doesn't pay dividends to their shareholders, even though they're wildly profitable. At the time of this recording, Amazon.com doesn't distribute any profits to their shareholders because they want to reinvest in themselves and become bigger. That's what Amazon and Google have done with their extra cash. They've reinvested in their organization to make their organization more profitable, worth more at the end of the day. So they're not expenses, they're dividends. Example of dividend, it should say example of dividend accounts, dividends distributions, or different dividends distributed, or we just call dividends. So dividends. So these there are 6 categories of which all accounts are concerned with. Okay, so we are concerned with assets, owner's capital, equity. Assets, owner's capital, expenses, liabilities, revenues, and dividends. So 6 categories here that you're going to need to know as we go in through future sections and lessons: assets, liabilities, owner's equity or owner's capital, revenues, expenses, and dividends. So ingrain those in your mind. Those are the categories. In the next lesson, we are going to take this even further, that granular, and talk about accounts. So every account can be allocated to one of these 6 categories. And so we're going to talk all about those accounts in the next lesson. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below, and I'll respond to you on what you got out of this video. So hope you enjoyed this video, and we will see you in the next lesson.